I think one of the major reasons is what you just said exactly. The momentum in the stock market, especially among some of these AI plays, the chip makers, anything related to that. People want momentum. There's a lot of people that like to ride momentum. Momentum is a well-defined factor. I come from the money management world before this, and it's one of the persistent factors. It's a bit of an anomaly. Almost every academic and market practitioner will tell you momentum is real. It's a thing. There's a lot of disagreement as to why it exists or why it can outperform, but it's definitely there. And so there's a lot of people that want this momentum. Most people can't hold dollars in more than one thing at a time. There's opportunity cost, right? And so
while stocks and AI-driven equities continue to capture investor attention, Bitcoin's recent underperformance may be setting the stage for its next major opportunity. Chris Kuiper is the Director of Research at Fidelity Digital Assets, specializing in Bitcoin, cryptocurrencies, and macroeconomic trends. He is known for his data-driven insights into Bitcoin's role in the evolving financial system. Chris Kuiper reveals that Bitcoin's recent weakness is primarily the result of capital rotating toward higher momentum assets, particularly equities that continue to post new all-time highs. With Bitcoin reaching one of its lowest RSI readings, investor attention and liquidity have shifted away from digital assets and towards sectors benefiting from the AI boom, including semiconductors, infrastructure, memory, and mega-cap technology companies. This concentration of capital has created a market environment where headline indices appear strong while many assets, including cryptocurrencies, remain under pressure. Kuiper notes that Bitcoin's decoupling from technology stocks is ultimately constructive, as lower correlations enhance its value as a portfolio diversifier. He argues that the current macro backdrop, characterized by strong labor markets, tight credit spreads, and relatively subdued inflation, has reduced the perceived need for Bitcoin. Meanwhile, persistent outflows from spot Bitcoin ETFs indicate that institutional demand is not providing the same support seen previously. Additional liquidity events, including the anticipated SpaceX IPO, could temporarily divert capital from crypto markets. Nevertheless, Kuiper believes Bitcoin's absolute scarcity and potential role as a hedge against monetary debasement will regain importance when macro conditions eventually become less favorable. What do you think? Will Bitcoin reclaim its momentum, or will traditional markets continue to dominate? Share your thoughts in the comments, and don't forget to like, subscribe, and share for more insights on Bitcoin, crypto, and global markets.
Bitcoin and other digital assets, and they've rotated into the latest thing showing momentum because, like we just said, we're at one of the lowest RSI readings for Bitcoin especially. And they're looking over here at stock market making new all-time highs, a lot of momentum there. And so really it is just as simple as that. There's just been a lot of vacuuming or taking the air out of digital assets, crypto, Bitcoin, everything in between. And everybody's mind space, the headlines, the attention, the money flows after that, that's all going to these other things. And so one of the silver linings of this, though, is that we look at correlations. And before Bitcoin was highly correlated to tech stocks, now it's not correlated to anything. Everything is going up, including things like gold and silver and all these other things. But Bitcoin is not. And so I think that's actually a great thing. You don't want high correlations because then you lose a reason to put it in your portfolio. You want to add things that have low correlation or even negative correlation. So it's, as one person just said, I was on another podcast, they said maybe it wasn't the decoupling or the break in correlation that we wanted, but it's the one that we deserved. If I could be so bold to say, is the environment might actually be too good for Bitcoin right now. If you just look at this from a macro perspective, and I think, there's a lot to say about the K-shaped economy and some of these indicators underneath all of this. But if you take just a very surface level, very high aggregate level look at the macro economy, you've got the stock market at all-time highs. You've got inflation relatively low, and now it's picking up, which is something we're watching very closely and something we've written on. Unemployment's been pretty tame and low. Job reports are pretty good. Credit spreads, narrowest they've ever been. So this says there's not a lot of stress in the credit markets, which is also what you see when times are very, very good. And so people are, somewhat rightly asking, why do I need Bitcoin? Everything else is working out great. Everything is doing well for me. Everything is going up and performing well. The macro environment is great. Why would I need Bitcoin? But that's just it. we want it to have that negative correlation. So we don't want it to be doing well when everything else is doing well. And not that I want bad things or negative things to happen, but as investors, we build portfolios for any environment we might come across. And so that's, of course, one of the reasons you might consider putting Bitcoin in your portfolio, because maybe you don't need it now. Maybe you don't think, or you're questioning what's the point of this now. But I personally believe there will come a time, whether that's inflation rearing its head, credit spreads blowing out, whatever it is, people are once again going to realize that they do need Bitcoin's investment characteristics, mainly the fact that it's got absolute scarcity, it's censorship resistant, it's this potential hedge against monetary debasement and inflation. And so eventually those things will come back. And then I do think we will see Bitcoin regain some of its footing for sure.
In a world of stretched valuations and rising macro risks, Bitcoin is forcing investors to rethink what truly belongs in a modern portfolio. Chris Kuiper reveals that despite rising interest in digital assets, many institutional investors still maintain a zero allocation to Bitcoin, prompting renewed research from Fidelity Digital Assets into whether its original investment thesis remains valid. He argues that Bitcoin continues to function as an emerging monetary good with long-term potential as a hedge against currency debasement and inflation. By analyzing returns, volatility, drawdowns, and portfolio correlations, the study challenges investors to justify why they hold no exposure, rather than treating zero allocation as a default position. Kuiper also highlights practical portfolio construction considerations, including where Bitcoin exposure should come from, optimal position sizing, and how to rebalance over time within diversified portfolios. Looking ahead, he points to structural pressure in traditional allocations, noting that both equities and bonds face headwinds from elevated valuations and persistent inflation. While stocks have enjoyed a strong decade, historical valuation metrics, such as the CAPE ratio, suggest lower future returns, while long-term bonds remain vulnerable to inflation-driven drawdowns. In this context, Kuiper suggests Bitcoin may serve as a complementary alternative asset. Despite being relatively young, Bitcoin has already matured into a major asset class, at times surpassing silver and ranking among the largest global assets, while also delivering top-tier performance in most of the past decade. Let's get back to interview.
We went back to it because, number one, a lot of investors, especially institutional investors, I'm sure not your listeners, but a lot of institutional investors, the big money, they're still on zero. So we still had to come back to this question or this idea of getting off zero. And second, we just wanted to update the data and say, does this still hold? So the report goes through Bitcoin's investment thesis, its core investment thesis, which we still view it as an emerging monetary good that is being adopted. And because of that, it's one of its ultimate potential functions is as a hedge against currency debasement, and then therefore also a hedge against consumer price inflation. And so we find those are still intact from a first principles perspective. And then we go through the actual data. If you're just objectively looking at this as an investor would, an institutional investor, you're looking at the returns, you're looking at the risk, the dispersion of returns. If you're looking at the drawdowns, if you're looking at how it interacts with other things in your portfolios, the correlation. We go through all of those things, and we really want to flip this on its head where we say to institutional investors, why is your allocation zero? And to be clear, some investors, zero may be the right allocation for them for a variety of reasons. But at least they need to do the work and come up with a good reason as to why that is, and actually go through the exercise. So we do all of that. The next section is then more on the mechanics of it. It's like, okay, I want some exposure. Where do I take it from? Which bucket, bonds or stocks, the risk bucket or not? How big of a position do I take? We provide a historical model as well as a forward-looking model on how to look at that. And then some of the other stuff like how do you rebalance or how do you maintain the position? And then the final part of the paper is we take more of a forward-looking view. The 60-40 portfolio, we look at both the 60 side and the bond 40 side and say, here's some headwinds that we see coming for both of these. And this is why Bitcoin may make sense to add into a portfolio. Yeah, so our forward-looking part on the end, we'll take each in turn. So on the 60 side, the equity side, which of course everyone's talking about today, stocks at all-time highs, which is great. It's been one of the best runs, the best decade for stocks in a very long time. And there could be a number of great reasons for that. But if you look at the valuation of the stock market on a very aggregate basis, a pretty crude measure is the PE ratio. We take the CAPE, the CA, cyclically adjusted PE ratio from Professor Robert Schiller at Yale. And it's a pretty simple measure where it's just taking the last 10 years of PE data. So you're smoothing out some of the fluctuations you get in earnings, hopefully getting you more towards a true cash earnings, not just accounting earnings for these companies. And it shows that when you've invested when this CAPE ratio is very, very high, your subsequent 10-year returns are quite low. And there's a great chart in the report that you can see this. The relationship is very, very tight for almost 100 years. And this should make sense to investors. It's the old Warren Buffett adage, or whoever said it, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. So you've got a lot of sentiment and noise and narrative, exactly like we're seeing with digital assets right now in the short term. But in the long term, the fundamentals usually bear out, right? And so what's really interesting is recently that CAPE ratio and the subsequent 10-year returns have diverged. And they've diverged the most they've ever diverged. So you're left with a conundrum here as an investor. Number one, you can say the four most dangerous words in finance, this time is different. I'm only half joking about that. Of course, there's good reasons that this time may be different. We're in a totally different economy with some of these mega corporations. They've got massive moats, great free cash flow. They've got network effects like you've never seen. And maybe the latest AI capex excluding, they've been fairly capital light businesses. And if you look at that, in periods of high inflation, you had a 40-year period where you were underwater on bonds. And you had a drawdown of 40-50% at one time. Today, you're looking at a 30% drawdown for long-term bonds because inflation continues to run above the Fed's target. And again, we got another hot CPI print this morning or yesterday, was it, right? So that's one of the concerns we have with the 40 portfolio. Again, not to say that, what's right for people is to not allocate at all, but just to start thinking about, like, we've got a couple big headwinds on the two biggest asset classes. Maybe it makes sense to look at Bitcoin in varying amounts as an alternative to help offset or alleviate some of that stress.
In an environment defined by elevated equity valuations, persistent inflation risks, and weakening effectiveness of traditional 60-40 allocations, investors are increasingly forced to reconsider how diversification should be constructed. As liquidity continues to concentrate in a narrow set of high-momentum sectors, particularly AI-linked equities, other asset classes remain under pressure despite long-term structural relevance. This imbalance highlights the importance of assets that behave differently across market cycles rather than moving in sync with broader risk sentiment. Bitcoin, with its fixed supply, evolving institutional adoption, and historically distinct return profile, is gradually being positioned within this framework as a non-correlated portfolio component. While still developing in maturity compared to traditional markets, its performance history and macro sensitivity suggest it may play a role in addressing future gaps left by both equities and fixed income. As macro conditions evolve, attention is likely to shift toward assets capable of preserving value across shifting monetary and liquidity regimes. Is Bitcoin quietly setting up for its next major breakout while everyone is focused on AI stocks?